Can you move your mouse around there just to make sure that you're good to go?
Sounds good. We are good.
Good morning, everyone. We're just going to we have a lot of people registered for this webinar, so we're going to give it one more minute, and then we're going to go ahead and get started here. So just bear with us here. I see the number increasing by the second here, so just bear with us here one more minute, and we'll go ahead and get started. Thank you so much. All right, we'll go ahead and get started. Good morning or good afternoon, depending on where you are in the country. My name is Josh Elohim. I'll be your co-presenter for today, alongside with Travis Frattini from the KaiZen program. We're truly excited to have this presentation today. Just some quick housekeeping for the purposes of the call. Everyone's going to be muted, and then just so we can get through this smoothly, we will have a Q&A session at the end, so please listen closely. It's gonna be a lot of information we're gonna go over today. So Q&A is very important at the end. Ask your questions and we will go ahead and get them answered on the spot here. We will answer the most pertinent questions and then try our best to, if not, reach out to your marketing manager, and we can go ahead and follow up with those. If you don't have a marketing manager, if you're not set up with Back9, please do me a favor. On the right-hand side, there's a chat box. I put a link in there for you to set up your account. So that way you can go ahead and sign up and have full access to Quote and Apply, our Back9 insurance technology, as well as to be able to have access to the KaiZen program. So without further ado, Travis, the stage is yours. Go ahead and take it over. Thank you so much. We appreciate it.
Great, Josh. Thank you so much. And thanks everyone for your time today. Josh and I have been working on, just to let you know, Back9's working on quite a few cases right now, which is exciting. They're a great vendor relationship that we have, and we were talking about what's the topic of this webinar today. What should we say that might get more individuals interested in being on this call? And I thought, what really makes KaiZen different? What is the main differentiator from the KaiZen program versus other, what you might call small face premium financing plans in the industry today? And we sat down and thought about it, and the biggest difference, the main difference, is that your client gets to participate in the use of leverage without having to personally borrow the money. There is no loan that they take out for the purposes of KaiZen. So what premium finance plan do you know of out there that doesn't require the client to personally borrow the money? Well, there is none, at least right now. And that's what makes KaiZen so exciting, and why I think, from a back nines perspective, they're excited as an IMO to offer this program on their platform. So that's what the topic of the conversation is today, is what makes this different? Where's the opportunity really lie? Who's the client that is buying KaiZen? What should you know as an insurance agent when presenting this plan to your clients? And some of the nuances. We're going to kind of go deep dive under the hood of the program, look at the illustration, and help you guys understand some of the main selling points and, again, differentiators of this program amongst others in the industry today. So what I want to talk to you about real quickly is who's NIW. NIW is a premium financing company who has been around for 20 years. It's our 20-year anniversary this year, and we're one of the longest, TPA premium finance firms in the industry. There's a few others that have been around as long as us, but we have a lot of industry knowledge and insight, relationships with some of the top lenders in the industry, facilitated well over $5.5 billion of loans with our key relationships, lenders, and of course, some of our carrier relationships are very, very strong, as we've placed, again, billions of dollars of premiums with some of the top insurers in the country. Now, NIW's origin is that we started in what we call the traditional premium finance space, where the programs were providing large amounts of life insurance through the means of fully borrowing the money from the lender, where there was really no client participation. This finance program was introduced to the owner of NIW when she owned one of the largest independent broker dealers in the state of Texas. And when she started presenting premium financing to her clients, she realized she liked this idea of leverage, but she wasn't really fascinated with the terms of the loans and even some of the products that were on the program at the time. And so she decided that she was going to make the loan and some of these product designs more applicable for her clients, safe for her clients. And so she went out and did that and decided that she was going to go ahead and start her own premium finance company. And that's the origins of NIW. And we still support and provide an incredible financing solutions for that very, very wealthy client, that client that's worth 10, 20, 30 or $1 million or more. That's a big part of who NIW is still today. But about 8 or 9 years ago, Grace realized, the owner of the company realized, that there was a tremendous market opportunity for individuals in what we would call maybe the affluent markets, the high income earning client, not necessarily the high net worth client. And those two clients have very different sets of problems, right? Our very high net worth client possibly has a very large estate tax liability that he'll be sending down to his children or people inheriting his wealth or her wealth. KaiZen, on the other hand, is really specifically targeting individuals that are high income earning, and their problem is that they're just not saving enough for retirement. And then we're going to talk about that specific problem, but they actually have a savings problem, not a estate tax problem. And she thought, if I could provide a benefit utilizing leverage for my high net worth clients, what if I could do the same thing utilizing a very similar structure, same product, and get those same loan terms for my high net worth client? How much more benefits would I provide my own employees, my own friends and family? And that's where KaiZen started. It started from her wanting to provide more and better benefits for her own employees, family, and friends. And then it was so wildly successful that she decided to open up the opportunity for agents like yourself. So that's a little history of the company and where we're at and how KaiZen originated. But I want you to think about this statement. You might even decide to write this down. And you need to ask this of your clients when talking about Kaizen, because you have to get them ready for the dialogue of utilizing leverage, because they're using it every day in their lives. They just sometimes don't think about it, or they don't think about why they're using leverage. So if you pose this question, did you pay cash for your house? Well, most of your clients are going to say, no, of course we didn't. But the real question is why? Well, in many cases, it's because they couldn't afford it, right? Most of us are living in houses and driving cars that we cannot afford to pay cash for. So we're utilizing other people's money or leverage to buy the home that we want or that we desire to live in. Think about these statements though. Pretty much every homeowner uses a mortgage to buy their house. Saving for retirement shouldn't be any different. And the reason why is that your retirement, if you're doing financial planning for your clients, is going to cost about 6 to 9 times more than the home they live in. That's a pretty big statement to make. But if we're supposed to live at our current lifestyle, or let's say 70% of our current lifestyle for 23 years in retirement, what's that nest egg really look like? Well, that's what Kaizen does. That's what Kaizen provides. It provides the additional dollars to fund the retirement gap shortfall that many Americans are going to be faced in the next 20 years. But there's a difference. There's no loan underwriting for this plan. There's no interest payments on this plan. There's no financial underwriting or personal guarantees for this money. And the net result to the client is 60 to 100% more retirement income than if they were to do this in a traditional retirement plan or traditional IUL. That's a huge, huge value to your client. And that's the loan, that's the leverage that we want to talk to you guys about today. So who are you targeting? Who's buying Kaizen? What's the qualifications? This is your target market you should be looking at. 18 to 65 is who qualifies. I will tell you 35 to 55-year-olds are probably the bulk of the Kaizen business. And you're looking for individuals that earn about $200,000 or more a year. So we are specifically looking for people that have annual incomes of about $200,000 or more a year, and it doesn't require any net worth to qualify. Another extremely unique part about the Kaizen plan. Now, they have to be in good health. It's life insurance, so you want to make sure that they're at least in standard or better health, and they have the ability to contribute 5 annual contributions to the plan. Now, why is that something I think that you should focus on? When we typically sell IUL to our clients today, we're usually running 10, 15, 20. I mean, back in my illustration days, I was, for a younger client, we were showing 20, 30 years of premium contributions. And the reality is the client will never pay that many annual premiums. What we know and what the carriers are telling us is that most clients stop paying premiums somewhere around 7 or 8 years. So why this is such an important part of the conversation is that they're done and they're fully funded this plan in 5 years. That's a huge, huge value proposition for a lot of individuals looking for alternative ways to save for retirement. And then of course the client has to have a need for life insurance. So most high income earners have a death benefit need. They have a family, they have people to protect, but they at least need to have at least a $1.5 million need for life insurance, because that's the minimum death benefit for the Kaizen program. The premium will vary based on the age on that $1.5 million premium amount. So who should you be targeting? Highly skilled, starting late in life, people that are maxing out their 401ks, people that are already in that high tax bracket and they're looking to diversify some of their future income from being taxed at rates that, we're going to talk about a little later, might absolutely shock our clients. About 20 to 30% of the clients that are in Kaizen today are going to be your doctors, your dentists, physicians. That's a big client base of our Kaizen advisors. Small business owners, financial services, technology, anyone that is earning over a couple $100,000 a year is who you should be thinking about in regards to profiling for, or at least presenting Kaizen to. Now, what makes you different And let's face it, we are in an industry where we all have access to the same product, the same illustrated rate, the same, there's not a lot of things that make us different other than you, right? Your personal experience and what you bring to the table. But the one unique piece about KaiZen that makes you different as an agent presenting it, besides the guy down the street showing the same IUL, is that you're offering to bring more money to the table to pay for it, right? The guy down the street is trying to get your client to put in 5, 10, 15 years on their own, resulting in X amount of income in the future. Well, you can provide that same benefit, but add 3 times more premium to the plan, which is why there's 60 to 100% more income. And you're allowing your client to do this in 5 easy payments. So you are differentiating yourself by bringing something to the client where they have extra money in the plan and they don't have to apply for the money to get it. You really have to get to the point where you're addressing the actual issues that are affecting your clients right now. One of the biggest fear that Americans are facing today is the inability to retire. Now, if you ask people today what their fear is, especially with the coronavirus and the economic situation going on in the world, this might not be the #1 fear, but it has been for years, which is I don't think I have enough money to sit in retirement to live the lifestyle I enjoy today. Because it's really a lifestyle question, right? And what all the stats are telling us is Americans are some of the worst savers in the developed world. We're only saving about 4.9% of our annual income as an American. And we know that that's just not enough unless you want to dramatically decrease your standard of living in retirement. Most advisors say that you need to be saving at least 1/3 of your annual income to maintain that lifestyle. Are our clients doing that? Well, we know statistically they're absolutely not doing that. Some even say that you need to have about 10 times your annual salary saved. Again, every statistic out there is telling us that our clients are absolutely unprepared for what the future lies in regards to their retirement dollars. Now, there's some positives in this screen that I want to emphasize to you guys. There's over 6 million households in the United States earning at least $160,000 or more a year that can qualify for KaiZen. That's a huge, huge market. I know a lot want to be in this high net worth arena where they're working with 10, 20, $30 million clients, but I will tell you that that's a fraction of the amount of people that are actually high income earners that qualify for KaiZen. So this opens up a huge, huge opportunity and demographic of clients for you to prospect to. Now, what this screen is also telling us is what individuals are supposed to be saving or need in retirement versus what they actually have. And what you can see is someone in the top 10% earning bracket needs to have about $1.6 million in retirement. But they actually only have reportedly about $274,000 in their IRA accounts or 401k accounts. The top 1%, just as bad. They should have about 3.84 million maybe. They've got about 1 million. So they're only saving about 1/4 of what's actually needed. So the question is what are you going to do to help a client like that? Because your only conversation that you're able to have when it comes to that big number is you got to save more. And how does that make your client feel when you tell them that they have to save 24 to 34% of their annual income to retire comfortably? Well, the likelihood is that they're not going to do anything because it's such a large number that they're not even willing to have the dialogue, right? With KaiZen, you're able to kind of bring that conversation or what they need to save down pretty dramatically because they're able to make the good use of leverage and the right asset class, which is an indexed universal life contract. So you're going to help them achieve their goals by bringing them a solution where you're bringing extra money, which is exactly what's needed to accomplish those goals. Now, from a medical expense situation, guys, we love life insurance because of the living benefits. Most of our clients are not even prepared for what is going to be a $250,000 expense in retirement on average for the average 65-year-old client. 70% are going to need some kind of long-term care. Not to say that that's exactly why they buy life insurance or why they would buy KaiZen, but that cost is going to be paid from some asset class. The question is which one? You know, whether you trigger a living benefit or not, life insurance loans are tax-free. You know, taking money out of a qualified plan to pay long-term care expenses might be the most expensive dollar they ever spend, especially when the market goes down or tax rates go up. How about utilize an asset class that's tax-free? Even if you don't use the long-term care benefit, those loans might subsidize the cost of that care. So it's an incredible tool to make sure that we have coverage for those expenses. Now, what about tax rates? Guys, we can spend an hour on this one topic. Everything that we are being told by the Congressional Budget Office tells us that benefits like Social Security, Medicare are projected to run out very soon. And the only way to deal with these things are doubling the tax rates. Doubling. So individuals that feel like they're paying a lot in taxes at 39% really don't understand how good we all have it right now. Now, I took this morning, right before this webinar, because I wanted to get a snapshot of where we're currently at in regards to debt. And we in the United States are at a $25 trillion national debt. Now, when I started doing tax-free retirement programs and PowerPoints and presentations close to 12 years ago, the national debt was $10 million. Now, what's interesting is taxes have not gone up much since then. As a matter of fact, they're some of the lowest in US history. But that's gonna have to change at some point, and the government's telling us about this and has been warning us about this for years. But our clients, for some reason, still think that putting money in a qualified plan is the only place they should be putting retirement dollars. They're so concerned about diversifying from a rate of return standpoint or an asset class standpoint that they're not thinking about being diversified from a tax standpoint. That's what life insurance, that's what KaiZen provides your client. Most of your clients don't even, most of the public doesn't realize that the average tax rate since 1913 is about 57%. Now that, I mean, again, this is information that a lot of Americans don't know, and most don't realize that it was as high as 94% back in 1944. Now that's really not the full story. What I think you'll find interesting as a financial advisor is it's not so much the top percent rate that we should be focused on. It really should be the threshold of income at which our clients will end up paying that percentage. That's the most important piece of this. I want you to pay attention to what happened from 1933 to about 1941. No one paid those tax brackets of 63% and 81% until they made over $5 million. Now, how many people were making $5 million in 1940, 41, 42? Not very many. But in 1942, the threshold went from $5 million to $200,000 a year, and the federal tax rate went from 81 to 88, and then 88 to 94. So all there has to do is be a change in that threshold, and all of a sudden now you have millions of Americans paying the top tax rate. So don't think that this is not looming in all of our future. We've got to have these conversations to get them to understand why life insurance, one, and why maybe the leverage, two, is going to be a good position to be in regards to a portion of the retirement savings dollars. Another part, what we have to do is get our clients to start focusing on the right aspect of the plan or a retirement plan. This is a really interesting statistic from Principal. They said 74% of your income in retirement is driven by how much you save, and only 26% is a result of your investment returns and asset allocation. So here's the question. Why is everyone focused on the 26%, not the 74? Right? We've been focusing on the 26% in the past 10 years because investments have done very well, and not on how much we actually should be putting away assuming that those rates of return that we've been getting for the past 10 years won't always be there. So that's a huge, huge part of why we think KaiZen is such a great asset class, and why the extra 3-to-1 leverage that KaiZen brings to the plan is what's going to make a successful outcome for your client. So let's get into the nuts and bolts here, guys. What is KaiZen? Where's the opportunity? Why does this work so well? Well, this leverage, this added premium dollar into the plan, puts more money in the plan working for the client, and which in turn provides more retirement dollars and death benefit. And for our high income earning clients, they are typically restricted to a certain amount of dollars they can put in traditional plans, unlike life insurance, where there are no contribution limits outside of what they can qualify for. Also, they get access and use of this 1-to-3 or 3-to-1 leverage of the plan for close up to 15 years. So they utilize this bank leverage for up to 15 years at a low borrowing rate of about LIBOR plus 175. Now, what does that mean in today's dollar or numbers? Well, LIBOR is running about 1.9, 0.8%. You add 1.75 to that, we're borrowing money right now at about 2.75%. Some of the most historically low rates to borrow money that we've seen in a long time. Now, how does this actually translate into premiums that your client puts into the plan versus premiums that the lender's contributing to the plan, and then of course the full 10-year premium payments? This is an example of a 45-year-old putting in $34,850 a year and for 5 years. Now the lender is close to matching your client's premium of about $26,679. Now in years 6 through 10, the lender fully funds the additional 5 premiums. So your client's putting in a total of $174,000, and the lender is putting in a total of $434,000. Yes, that's the 3 times leverage that we're talking about. So after your client's 5th premium payment, they are done funding this plan, and it is on autopilot from year 6 through 10 from the lender's perspective. Now, what does this visually look like? What's going on behind the scenes and how is it structured? Well, again, those first 5 premiums are matched with the bank's 5 premiums. And those 5 premiums from the client covers things like cost of insurance, fees, expenses, and charges typically associated with an overfunded life insurance contract. Those 5 premiums are also what secures the loan for the additional 3 times leverage that the lender is putting in the plan. After 10 years, the bank stops contributing to the plan, and we let the policy grow for an additional 5 years. So this is a 15-year wait and hold, I would say, in regards to how long your client needs to wait till we exit the loan in year 15, pay back the lender via a participating loan, and then we can start taking retirement income dollars out of the plan in year 16, or in this example, a 65-year-old being able to take approximately $57,000 of income out from 65 to 90. So this is structurally how it works. So if you're selling IUL today, the design isn't much different than what you're currently showing a client. It's just that we're waiting until that 15th year to exit the loan to start taking those distributions from the plan. So what does this illustration look? What can your client and you expect in regards to what's inside this illustration and what you can use to present to the client? Well, every illustration comes with an explanation of what KaiZen is, why traditional retirement plans are insufficient, and why this plan is not only there to protect you from an income perspective and a living benefit perspective, but of course, because it's life insurance, it's there to protect the family as well. It goes over the death benefit features, the living benefits, as well as depending on the carrier you use, there will be critical, chronic, and or terminal, again, depending on the insurance company's riders that they offer. Now, the next page goes over the cash accumulation features. How does the expenses work and what do they pay for? How does this excess premium accumulate cash value? It's basically a life insurance 101 in a very, very clear and concise manner that unlike a 30 or 40 page carrier ledger, this really just goes over the highlights of how an S&P cap works and what those benefits are and how they accumulate inside the contract. Then it gets into the unique use of this leverage. This is where the client's putting in their 5 premiums. It shows the leverage in those first 5 years from the lender, and then that total leverage coming from the lender from year 6 through 10. And then there's another slide that compares an after-tax investment with a self-funded plan versus what you would get in a KaiZen plan. Now this is a pretty it's kind of a unique and cool slide because or page because it shows the client, look, if you were to take that $34,850 and just invest it on your own in an after-tax investment, utilizing the rate of return from the carrier, an income tax bracket of 37%, and a long-term capital gains of 20, what would you get out of that plan at years 65 to 90? And in this case, we would get about $25,000 of income out. Now, what if you were to use the IUL you're selling today, guys? A 5-pay IUL with any carrier. In this particular example, it's National Life Group. What would that income be? Well, in this case, it would be $28,000 with a little bit of life insurance at the end. Now, what about KaiZen? This is where this 60% more income and benefits or 100% more income and benefits come from. We go from $28,000 to potentially $57,000 of annual income with the same $34,850 for 5 years, taking our total distributions to $1.4 million and over doubling the death benefit protection for the client. Same dollars. So remember when I told you, you guys are unique in presenting KaiZen versus what your competition is showing? It doesn't even matter what illustrated rate of return they show. You're bringing more money to the table in turn, providing them with the ability to get 60 to 100% more income than anything else that's being shown out in the industry today. Now, every single one of these plans are stress tested to deal with various economic environments. When we put this program together, the lender and the insurance companies wanted to make sure that the plan could make it through, we would say, tough times. And the 2 worst environments for a financing plan would be the Great Depression and the high interest rate environment of the 1980s. Those would be probably the 2 most stressed environments that you could find that would negatively impact an indexed universal life contract that's utilizing leverage. All right, so what we have in every one of our illustrations is what would the income look like during a stressed environment, and then what would the income look like in a Great Depression environment, and then what the income looks like if you were to self-fund. And this is what's interesting. Let's look at the Great Depression. What a Great Depression scenario looks like is that we put 9 zeros in a 15-year period over the top of an illustration to make sure that in an environment where we got, and by the way, 5 zeros in a row from 1930 to 1934, and then 4 more zeros over a period of time, as you can see on the slide. We take an illustration, we superimpose those zeros on top of an illustration in a spreadsheet and we make sure that under these conditions, this is 11 1/4 cap, which, by the way, the actuaries of the carriers told us they believed during that period of time they could sustain an 11 1/4 cap, and a borrowing rate, a Fed fund rate of 4%, we could still pay back the loan plus interest and get about $34,000 of income out of the plan at age 65. Now, it's not 57, but it's much higher than 28. So this makes the plan will work as long as it's funded and we can hold on for 15 years and wait that duration. We can still get about $34,000 of income out of this plan. Now, what about the high interest rate environment of the 80s? Well, this was an anomaly. We've never seen this ever. We haven't seen this since 1980 to 90, where these fixed interest rates and loan rates were in these double-digit rates of return. But if anyone was in the business back in the 80s, if anyone remembers what mortgage rates were in the 80s, my father, his first home in the early 1980s, had a 16% interest rate on the mortgage. Now we got 30-year mortgages at 2.9%. But we also, the positive flip to what was happening in the 80s is life insurance yields were in the double-digit range. If anyone was in the business in the 80s, they'll remember UL were projecting 13, 14% fixed interest rates of return. Well, if that ever happened again, the insurance companies told us that if they could invest those premiums in bonds like they did in the 80s, they would have been able to purchase options to buy cap rates that were 18, 19%, even uncapped for various years in the 1980s and early 90s. So what we said is that's great, but instead of taking it to uncapped, we're gonna maybe raise the cap only to 15%, making sure that we can still exit the loan, pay the interest back, and get a reasonable income for our client. So that's what we did. We never took the cap over 15%, and we were able to pay back the loan plus interest and still get around $46,000 of income. So it doesn't, again, not 57, but not 28 either. Both economic black swan events still produced higher potential income than if you were to self-fund the plan. And the biggest reason for this is that we never stopped funding it. See, the self-funded plan only has 5 premiums going into it, and then we're done, right? With KaiZen, we are fully funding through these economic environments, whether they're 0 years or not. We're fully funding it, we're properly funding it, we're holding it for the proper amount of time. And if you do these combination of things, the outcome is a much more positive outcome when utilizing leverage versus doing this on your own. So again, every plan goes through this, and it's a huge selling point of the KaiZen program. Now we're going to go over an example of an illustration. This is a National Life quote. By the way, I'm only doing this because there's 3 carriers on the platform, and I just wanted to kind of show you what an illustration looks like. So this happens to be NLG. We use the Peak Life product with National Life Group. And what you see on every ledger at the top is the age of the client, the rate of return at which we're illustrating at, the bank margin at which we are using, which is 1.75 over LIBOR. And then we use option B as the design, and then you can see at the top right-hand corner the death benefit of $1.5 million. So that's what you see inside each one of these ledgers. Now, what we use is the Enhancer Plus on that particular strategy, and we use the 1-year high cap strategy for National Life Group. And something that we do that's a little unique in regards to these illustrations is that we lower the income that's shown on column K by 20% of what the illustrated values actually come from the carrier level. So we are reducing the benefit substantially to try to help deal with sequence of returns and market volatility, which is going to be normal in an IUL, to give our client a better perspective on what their realistic numbers should be versus over illustrating. So we do this on every single one of our ledgers to kind of be conservative in regards to what the client's expectations are out 20 years from now. Now, what you see on this ledger is on the left-hand side, that's the loan rate plus the spread. Now, this is an older illustration. It's about 6 months old. So LIBOR plus spread was a little higher even 6 months ago. Today, that would be around 2.75. The total premium paid is in column B. The next column is your client's premium. That's the 5 premiums that they're going to pay in the plan. Column C is the total loan amount that's being loaned to the plan. And then column D is the loan plus interest rolled up into the 15th policy year, at which time that is the loan amount that's projected to be paid back out of the cash values of the contract. Now, column E is just the annual loan plus interest on an annual basis. But kind of here's where the magic is. And this is what I really want to show you guys why KaiZen is so powerful. What I want you to focus is on column F and G. Usually what you guys see is a cash surrender value and a cash accumulation value. And the cash accumulation value is usually a lot higher than the cash accumulation value of every IUL that you sell. And that's because there's surrender charges and penalties, typically about 10 to 12 years, right? We're all used to that. Now, the unique part about this plan is that we utilize what's called an early cash value rider, or with National Life Group, it's called a balance sheet benefit rider. And all that does is waive the surrender penalties associated with the plan. Now, why is that important for KaiZen, or from a KaiZen perspective? Well, in the KaiZen plan, the life insurance is the sole collateral for the loan, which means that there's always got to be enough cash value in the plan to make sure that the lender is paid back in any given year if the client surrenders and or passes away. So I want you to look at column 1 real quick again. 60,000 is going in the plan. 34,000 is what the client's putting in, and the bank's matching that with about 26. Now in column E, the loan plus interest is about $28,000. Now there's $51,000 in the life insurance policy. So if something happened and this client walked away from their contract, they would get that there's enough cash value to pay back that lender that's $28,000, and the client still has $23,237 to walk away with from its $34,000 contribution. Now, on every single ledger you ever sell moving forward, look at what their walkaway number is versus what the client's participating with. And they're usually walking away from about 90% of their annual premium in the first year. In this case, it's nominal. It's about 10,000 of their original 34 that they still get in surrender value after the program is terminated if they needed to. Now, if the client passes away in any given year, there's clearly always enough death benefit to pay back that lender plus interest, and then the client gets all their money back, or I'm sorry, the beneficiaries of the trust gets what's ever left over in the death benefit. So the lender is always protected in this plan, and is why the client isn't actually the one borrowing the money. We're going to get specific into that in a minute. Now, in year 15, we pay back the loan. I'm sorry, in year 10, we do an option B to an option A. We pay back the loan in year 15, and then we start taking income at year 65. So this is a standard illustration that you'll see in every one of our ledgers. Okay, so does this all sound too good to be true yet? Well, it shouldn't, and it shouldn't be for your clients either, because when you're explaining the benefits of utilizing an asset class like IUL, and they understand that this product cannot lose a dime to the market, and it can capture about 80% of the upside, and the only real cost or drag to the plan are the internal costs of insurance, which I'll talk to you about in a minute, why those are so low. They'll understand that this is not too good to be true from an asset class standpoint. And that zero floor is why lenders and banks that we use love this asset class, because they understand the value of not losing a dime to market volatility and being able to capture about 70% of the upside. They understand that. And when you design an IUL like we do with maximum growth, minimum costs, you fund it properly, you let it sit for 15 years. Our average cost of insurance, our weighted average cost of insurance over a 15-year period is around 1%. That's pretty good in regards to a life insurance design. That's about the cost of what some clients are being charged in mutual funds, 401ks, and managed accounts. So from all intents and purposes, it's an incredibly cost-effective asset that doesn't lose any money to the market and that captures 80% of the upside at about a 1% cost. And by the way, the cost isn't just to manage your money. The cost comes with benefits, life insurance, living benefits, and tax-deferred benefits. So it's a huge, huge value add. That's why the lenders like this plan. The banks also have confidence in this plan because we do all the stress testing. We do all the annual servicing. We have a very high persistency rate. We've been doing business for over 20 years, and the banks and the insurance companies know, and this is a dated slide, that we've done over $5 billion of loans that have stuck to the books and it's a very, very clean business for all parties. So what we have to do is get our clients to start thinking outside of the box. See, they don't usually think that borrowing money really comes with risk. I mean, they do this all the time. What most of our clients don't realize is that there are actual bank divisions within banks that lend the life insurance by the millions. So it's a very common transaction for a lot of name brand banks across the country. We just have to help our clients understand that. So you can get all of this with no loan documents, no personal guarantees, no credit checks, and no financial underwriting. Now, how do we accomplish this? Well, I already explained part of it. We're accomplishing this because we're letting the life insurance be the sole collateral for the loan. But what about the borrowing of the money? Well, the only way that you or your client can get loan rates at LIBOR plus 175 is you would have to literally borrow close to about $700 to $1 million to get LIBOR, 1-year LIBOR plus 175. And remember, we're only borrowing maybe $30,000, $40,000 a year at a time. So how is it that we can get LIBOR plus 175? Well, what we do is we will call tranching the business. We pool literally 50 to 100 clients every few months together, and we borrow in bulk. So here's how it works. There's a trust in Nevada. We use Provident Trust, it's the second largest trust company in the country. And every one of your clients that buy a KaiZen plan get to own their own living KaiZen trust. And that trust is tied to a master trust, who is the actual borrower of the dollar. The bank will lend that master trust the money once it gets all of the premiums from all of these other individual trusts set to this master trust. Now, once all of those 100 plus policyholders send their money to the master trust, the bank sees that, matches it, and it sends all of those premiums to the insurance company. Now, why is this such a unique arrangement? Well, the bank is not lending the money to Dave, Paul, or Brian. The bank is lending the money to the master trust. This is what makes this plan so unique, right? The master trust is a fiduciary and a protector of the bank's dollars. It knows that if Paul or Dave pass away, the death benefit will swing back into the master trust and pay them back. The bank also knows if Dave and Paul walk away from their contract, that master trust has the ability to get the cash value it needs to pay back the lender plus interest, and Dave and Paul get to walk away with the difference. But this is what keeps Dave, Paul, Brian, and Scott from having to personally borrow the money from the facility. This is very important to talk about because the other programs out there, Dave, Paul, and Brian have to take a personal loan out on their credit. They have to get approved for it. Where our program, you do not, which for someone that's earning $200,000 to $300,000 a year, they may not want to borrow money to pay for this plan or it be on their credit. So it's a very, very attractive consumer-friendly proposition when your client's not personally borrowing the money, but they get all the benefits of the leverage. Now, lastly, why these lenders are willing to do what they're doing with this plan is that we do all the annual servicing. So every year your client gets an annual statement and a service to say, here's what the rate of return is this year, here's what the bank interest rate is going to be for next year, here's what your cash accumulation has done over time, here's where you're at year to year for 15 years. We service these plans for 15 years. Now, this is Grace's policy. She posts her policy every year for you guys to utilize in the field. She's averaged 8.7% in the past 6 years, a 3.5% loan rate, and a spread of over 5.2%. That's what her own personal policy has done in the past 7 years. So understand that NIW services this until the loan is paid back, and we stay with your client, ultimately, whether you're in the business or not, to ensure that your client's serviced and that the bank is serviced as well. These are the 3 carriers that we're utilizing under the KaiZen program: National Life Group, Allianz, and Securian. All great companies, all with their different pros. I wouldn't say any cons per se, they just all have different nuances that make them good. And of course, you can call Josh or anyone at Back 9 to discuss what direction you might want to go from a carrier perspective. So one last thing I like to bring up is how you get paid and compensation in regards to the plan. Everyone ultimately knows that the BSB or early cash value rider comes with a different way of getting paid. What NIW does is that we are on the app at 30% as the TPA. We create all the spreadsheets, we facilitate all the legal and trust work, we complete the annual renewals and calculations. We prepare the first year lending and the lending renewals and refinancing if needed. What we ask you to do is make the sell and obtain the underwriting offer. You are not involved at all in the banking side of this transaction. That's what the split's for. We're on the app. You don't contract with us, you contract with Back 9. Now, of course, you know that there's a couple ways of getting paid. Either up front, target excess and renewals, or you can get paid as a spread comp. And that's what the BSB or early cash rider does. And let me show you why. And that's what allows the policy to be the sole collateral. So understand, guys, you couldn't get a loan like this under the conditions at which we're offering without offering that liquidity up front. So is spread comp bad? Absolutely not. It's just different. So this particular case that we were looking at today, that target was at about $11,000. If you were at an 80% contract, you'd get $8,900 up front and a comp of over the next 5 years of about $11,000. If you were to get paid spread comp on the same exact case, you would get about 17% of that target paid to you every single year for 6 years, plus excess. At the end of 6 years, that's about $9,000 in comp. And then renewals kick in 7 through 10, which is a total of about $15,000 in compensation. So you get paid more, you just get paid differently. And that's really what I think everyone needs to understand. The compensation is fair, it's good. It just gets paid differently because of the way that we structure the plan with that early cash value rider. So how do you get involved in the program? Well, Josh has access and his team have access to the selling agreements. Back 9 is a approved partner with NIW, so you can get that selling agreement from them. Once we get that back, that will give you access to the KaiZenPlan.com website. It gives you access to illustrations, marketing materials, webinars, training PowerPoints, you name it, it's on there. And you actually, and my typo, my apologies, the next tranche is May 26th. So there is time to get business in this month for this particular tranche. If it doesn't make it in this month, we have 3 more for the year. So if you have cases that you want to present right now, you could absolutely get it into tranche 31, and Josh and the team over there could support you on that. So Josh, that's it for me. If you want to take the screen over and open it up for dialogue and questions.
No worries at all. Travis, as usual, phenomenal, great job. I want to go ahead and open this up for questions now. So please go ahead and ask your questions. If you, again, if you don't have a Back 9 insurance account, if you're new, please go to the chat box and go ahead and click on there's a place you can go ahead and sign up if you don't have an account. If you do have an account, reach out to your marketing manager. But let's go ahead and answer some questions here. Again, Travis, as usual, phenomenal job, and then we'll go from there. So let's see if I can show my screen here for anyone that has any questions. All right, so please go ahead and put in your questions there if you don't mind. So there's my contact information if you need help, if you don't have a marketing manager. And again, thank you, Travis, so much. Greatly appreciate it.
Of course, of course. And I know there's a lot of information, Josh. I mean, that's a lot to download in an hour. What I would say, just while you're gathering some of those questions, I'm going to just tell you guys how I got myself familiarized. Is when I got presented this 4 years ago, I got onto the website, I downloaded every PowerPoint, I studied every note that Grace put in her PowerPoints, I watched every Friday webinar, and I spent a lot of time educating myself. It's not going to happen overnight, but the tools and resources on the website do provide enough for you to do a lot of self-study. And then Josh and I have been doing some meetings together with advisors when you guys have some cases. So understand the resources are abundant. And again, a lot of information to download. So understand it's a process.
Absolutely. Okay, so someone asked if you could explain kind of the tranches, how that works, how that works again.
Yeah, so what you see on the, I put up those tranche dates. And when we first so the way that we get the pricing on the loans is that we have to borrow, ultimately millions of dollars at a time to get the pricing for the client to make this work, right? So what we do every 2 months is we tranche business. So for instance, this next tranche deadline is May 26th. So if you had an application, Josh, that you sent in right now, and the client was already approved, we got the underwriting offer, their policy and plan and trust work would need to be submitted to us by May 26th, all right? And by the way, there's 70, 80 to 100 people doing the same thing on May 26th. All that paperwork, all of the premiums, everything comes to us, and we send all of that money to a trust account, and it funds on June 24th. So we gather all the paperwork, we get all the approvals, we get all the money, we send it to the trust, and all of these plans get funded on June 24th. And then that happens all over again. So every 2 months, what we're doing is we're getting, enough participants in the plan every couple months to be able to borrow $2, $3, $4 million at a time to get the pricing we need to put another set of 100 to 200 clients into the plan every couple months. So that's what those tranches are there, so that we can basically come up with enough clients and premium to borrow the amount of money at the price rate we need. Now, a couple of years ago, we were only doing 4 a year, and we're now doing 6, and probably by next year, that's going to go up again. So as you can tell, we're tranching and gathering more clients every year, which is allowing us to do this more often.
Thank you, Travis. I really appreciate that. This question has 1 or 2 parts to it, but it says, do you check the client's annual income, which is one part of it? And if the client, if they can pay in a lump sum of money, like how does that work if they have the money up front?
Yeah, so what they're basically, National Life Group and Allianz, National Life is looking for 2 years of reportable income over 100,000. Why my presentation says 200, Josh, is because people making $100,000 in many cities and states they couldn't afford KaiZen at a $20 or $30 premium. So the carrier is looking for 2 years of 1099 or W-2 income. Allianz looks for annual income as well, over 100,000. They have a net worth requirement, which which is on our website. It's anything over 200,000 of annual income. They have a net worth requirement of 500,000. Now that being said, can a client just pay for this all up front? Yes, they could take all 5 premiums and put it in their trust account, and that trust then can pay for the premiums on an annual basis over 5 years. You can just, now the trust account is a money market account that pays next to nothing, but it is sitting in a bank account in your trust, and that can fund your 5 premiums. So we see that done quite often. We aren't allowed to use the PDA or PDF accounts at the carrier, because the premium for these plans must come from the client's personal checking accounts. It cannot come from a third-party source. So those PDFs or PDAs won't work, because the trust company won't accept that payment from the insurance company. So, but we do single premiums all the time inside the trust.
Perfect. Thank you so much for the heads up there. So a lot of people are asking like kind of what's next. So again, reach out to your marketing manager. They can help you out. There is some documents that need to be signed for KaiZen. If you don't have a marketing manager, again, in the chat box, you can go ahead and click on there, and you can get a copy of the what's needed to be signed and back to you there. Just a few more questions here.
That real quick, from a selling agreement standpoint. So what that selling agreement is for everyone on the call, that's nothing more than an NDA, and it spells out the splits on the various financing programs at which we offer. And it's basically just asking you not to share our material with competitors. It's your standard NDA language. That's going to give you access to the website, the illustrations, the PowerPoints, the trainings, and so forth. So once you get that back from Josh, you get granted all of that access.
Thank you very much, Travis. This is a great question. Can a parent sponsor or guarantee for a child that earns less than the required income and have less net worth?
It depends. So let me explain that answer real quick. The National Life Group has some pretty black and white rules in regards to what the client is making on an annual basis. Allianz a little bit grayer, but here's what you have to do. You have to prove that this parent or this client is ultimately, this is like a future inheritance or a gift, right? That's one thing that you have to kind of say, okay, here's the parent's income, here's their net worth, here's why they're doing it for the adult child, because you've got to be an adult to do KaiZen 18 or older, because the child is going to be the owner of their trust. The parent cannot be the owner of the child's trust. So that's got to be a part of this equation. So you got to prove to the insurance company that the parents have the financial ability to do so, and that this is a part of a gifting strategy or a future inheritance. Secondly, you have to make sure that the client the child can actually get approved for $1.5 million of life insurance. So if they're not earning $100,000 or more a year, their annual income might not justify the death benefit. So you still have to, from a multiplier standpoint, at their age, their annual income has to justify the need for the life insurance. So there are some hoops that you have to jump through, some cover letters to write to explain to the underwriter why you believe this is a suitable sale. And you would just work with Josh and I and the back nine case management team to see what either or carrier would offer based off of the cover letter. I know that's a long answer to a short question, but this plan, guys, this was designed for white collar employees, executive benefits, high income earners. Even though it's an incredible plan for younger clients, you have to kind of justify the sale still.
Absolutely. Here's a great question. Let's say you had like you mentioned about, white collar. Let's say you had a group of, this is a question here of, 20 employees that are all high level. Is there any simplified process to get that done, or is that just one by one?
Yeah, so if it's a group and a company, we have simplified and GI abilities with National Life Group for employees or participants of 10 or more. So, and there's participation rates that have to apply based off of the amount of people that are being offered the benefit, but there are GI and SI opportunities. You would just have to work with Josh and I to give us an idea of the size of the company, how many of these are going to be offered to these individuals, is the company sponsoring it, or is it completely volunteer or voluntary? There's some nuances, but there is a way through National Life Group for us to get SI and GI offers depending on the group size, which simplifies the paperwork tremendously.
Perfect. Well, listen, this has been an hour here, so I really appreciate everyone staying on board for so long. Hopefully this has been a wealth of information here, an incredible opportunity with KaiZen. Hopefully we can start getting some business going here. So again, Travis, thank you again so much for your time as usual. Always phenomenal. And we'll keep the party going here, everybody. Thank you again. And listen, everyone, have a blessed day, okay?
Thanks, Josh.